Welcome back. And in our business news, the UAE has been named the world's 20th biggest exporter of merchandise trade, exporting $285 billion last year, according to the World Trade Organization. According to a local paper, the merchandise trade volume passed those of Australia, Brazil, Switzerland and Sweden, and was next to India, which came in at the number 19 spot. The WTO also revealed that the UAE constituted 1.6% of the world's exports, which stood at $18.215 trillion of merchandise trade in 2011. It added that the UAE is the world's 25th importer of merchandise trade, having imported merchandise worth $205 billion in 2011, which represents 1.1% of the world's imports of $18.38 trillion. The United States of America tops the list of importers with $2.265 trillion of imports in 2011. Investors should position for the great rotation out of fixed income and into equities. That is likely to begin in 2013, according to the experts. Merrill Lynch Wealth Management held a press event in Dubai today for their global and regional outlook for 2013, revealing a brighter economic and market outlook than last year. Officials stated that growth should begin taking over from policy as the key focus for investors next year, leading them to favour equities over bonds in 2013 off the back of a notable valuation gap between the two asset classes, now at its most favourable level for stocks in over 25 years.
We are of the view that fixed income, especially government bonds in developed markets, are gradually going to be the place to avoid. So that's the key. Then within that, we look at equities and we prefer to be overweight of European equities on a valuation basis and emerging markets on a prospective growth basis. From the point of view of macroeconomic growth, we are more positive on this region than quite a few others, thinking a GDP in the region of about 3% or more, 3.5%, that kind of range. From the point of view of what are the drivers, we think that the generalized sort of robustness or the strength in emerging markets should be a positive. And then one of the main risks is the potential exposure to Europe via the deleveraging of the financial system, where European firms European financials are still in the process of deleveraging, and that is having a global effect, not just a localized one.
The head of strategy for Merrill Lynch Wealth Management, EMEA, added that another important finding from the report was the long-term demographics in the Asia-Pacific.
Interesting theme from a very long-term point of view that we've highlighted is the change in demographics in especially sort of what's currently emerging Asia, but as it emerges, it's a very important piece to mention, is that at the moment something like a quarter, just more than 25% of middle class incomes are generated in the Asia-Pacific region. In the next 2 decades, that is going to double, in fact, more than double. So that's an important sector. So, 50 to 60% of middle class consumers will reside in Asia-Pacific, so by the year 2030 at current demographic trends. So that's an important area for investors to focus on and see if there's positive exposure to be had.
And with that, let's now take a look at the stock indices across the GCC.